All right, let's get the read from all of this and the implications of all of this from market watchers Mark Matson, Rebecca Walser, and Jared Levy. Jared, to you on the criticism of the Fed. Few presidents really like a Federal Reserve raising interest rates. Most keep it to themselves. This president chose not to. He's frustrated by it. He thinks it's getting in the way of a recovery that could be nipped in the bud. What do you think of what he's saying?
Well, it's his style to use the media to his advantage, right? I mean, he's going to put that out there because if rates continue to go higher, which they very well may, he can then say, hey, back in October, I complained about this and I complained about it before. And sure enough, look at what's happened. So it kind of becomes a scapegoat, if you will. At the same time, I don't know if I would blame rates for what's going on right now. I think that what's happening right now is in the grand scheme of things, in a vacuum, very natural. I see, in my opinion, the midterm elections and lead up into that being more of the catalyst here. Investment managers around the world and traders, all they're thinking about is, how do I play this midterm election? What if Democrats take the House or the Senate or both? And they probably had stops in place. So as the market started to turn down, these stops started triggering, and that's what accelerated a lot of what's going on. Because if you look at the bond markets, it's not, everybody's jumping into bonds. It's not that sort of a switch. So again, rates, I think, partially to blame here. I think the president's getting ahead of it, but I don't think it's just rates that's setting the markets lower.
Rebecca, the fact that the president even mentioned the possibility that he was not thinking of firing Jerome Powell, the Federal Reserve Chairman, is kind of scary in and of itself, is it not?
It is. Obviously, that would be a very unprecedented move. I don't feel sorry for President Trump, but I do sort of feel for him, because I feel like what he was saying that you mentioned during the election was, President Obama doesn't deserve any of the credit for the economic bull run that we had under President Obama, because it was pure monetary policy. It was lower for longer, and it was cheap money that was really sustaining the crazy stock market. And so that's what he was saying, is don't give any credit to President Obama. Now he's got the opposite problem. He comes in, he cuts taxes, he has a great deregulatory policy. It is having a huge impact on our economy. It has had a huge impact. And now the Federal Reserve is doing its job to make sure the market doesn't get overheated, and they have to raise interest rates. And he doesn't think it's fair because it's going to affect his recovery and his bull market.
You're absolutely right about that. I mean, the fact of the matter is he has bemoaned this, and throughout the years talked about how the Federal Reserve was falsely propping up the market. And, of course, he wasn't going to give any credit to Barack Obama. Many do, as you have indicated, give a lot more credit to the Federal Reserve, keeping rates at near zero for upwards of 8 years. That would help. But he had also said in an interview later that same year with CNBC, talking about the 0% interest rate environment. Mark, I want to raise this with you. Well, it's staying at zero because she, referring to Janet Yellen, the Federal Reserve Chair, is obviously political, and she's doing what Obama wants her to do. She should be ashamed of what she was doing to the country. So you could make the argument, I think, as Rebecca just did, that the Federal Reserve had an obligation to get a normal range in rates, and 0% was not the normal range. And now the Federal Reserve is playing catch up with that reality because it's more comfortable doing so. But it is going to stick it to this president. What do you make of that?
Well, yeah, well, I'm not really concerned with who gets credit, who doesn't get credit. What I'm concerned about is everyday Main Street investors who are trying to plan for their retirement and plan for their American dream. What do they do when they see a massive drop in the market like we've had over the last week or so? And that is what they normally do is panic. They get really afraid. They sell stocks. They buy bonds. And what they should be doing is the exact opposite. The market was down 4% yesterday. Investors should rebalance their portfolios, sell the fixed income, and buy stocks while they're cheap. Now, they're cheap in America, but they're even cheaper internationally.
Internationally, they're catching a falling knife, right? So how do you advise your clients who, if you rushed in, let's say, the Thursday of the week before the October 1987 crash, when the market was tumbling, and then sort of that was a daredevil time to come in, obviously you were going to lose another 24%, right? So you never know when is the right time to get in. Why do you think now might be?
I'm not talking about getting in. All investors, long-term investors, should have a portion of their money in equities. Don't jump in and out trying to market time it. You're never going to know when exactly it's going up and down. But what I'm saying is international is down even more. International is down 10%.
That's right.
And what you want to do is you want to rebalance, sell the things that are high. And it's against your human emotion because everybody wants to stay short-term focused. They get afraid and they panic. And what we want to do is stay 10, 15, 20 years. No one knows what the next 20% move is, but historically we know the next 100% is up. So don't panic and stay in there.
But Jared, there's another view. Just keep your holdings the way they are. Don't do a darn thing. What do you think of that strategy?
Well, it's not bad compared to what most people do.
First, go ahead.
No, I think we're kind of in the same boat. You know, I think from a psychological perspective, you know, I can't tell you. I mean, literally, my mother's calling me, my grandmother, every client. What's happening? Should I just jump out? And I think you've got to take a step back and look at your time horizon. If your time horizon is next week, all right, maybe it's time to go. But if your time horizon is several years out, again, use these moments to target stocks that you would like to buy, and use the moments like a lot of people are doing to maybe take profits in the Amazons and the Facebooks and the ones that you've had great gains on. You know, again, it all comes back to psychology. And as much as we can get up here and tell people to calm down, they're not going to until the market starts to creep back higher, until the confidence returns. So hold your course, look at your time horizon, and you know, be aware of what stocks you're in and not in.
Rebecca, do you share that view that with all the attention on the sell-off in the last couple of days, we're still appreciably up, and we've still seen some eye-popping returns for stocks that, even when they go into bear market territory, are up a whole lot? Amazon getting close to that, but still up 50%.
Yeah, you know, I do agree with that, with Jared's point. You know, I think, Neil, what's happening here is, and there's a really big thing we cannot forget, there's an overarching psychology of a couple of things. One, we are in uncharted territory. This is the longest bull market in the history of our country. So I think you have people that have been sort of stuck in the equity market because there's been nowhere for them to go, and they're starting to look at these yields and say, hey, you mean I can get over 3% for the first time in 9 years? That sounds like a deal. And they're starting to look at these yields, so you're going to see some of that.
And guaranteed. So, Mark,
no
if that's the case, I mean, at what level do investors sort of weigh that and think, boy, you know, 3% doesn't sound like a lot, but it's more than losing right now 30%?
No, and 3% after taxes is more like 1.5%. So, you know,
don't
historically,
think that
large companies
going to work in favor.
It doesn't allure me.
Okay.
I mean, if you look at stocks, historically, the S&P's at 10%, microcaps at 12%, and small value at 14%. So, you know, if you're planning for long-term retirement, you need to have real growth in your portfolio in excess of inflation, and inflation's 3%. I got 3% inflation, 3% minus taxes. I'm underperforming in inflation with T-bills. So, no, I'm not convinced that's the way that you plan for a long-term future.
All right, guys, thank you all very, very much.